rectangle is a price pattern that forms when a stock has touched support and resistance levels at least twice during a sideways trend. These movements create the pattern's rectangle-like shape. Rectangles are continuation patterns that may present unique trading opportunities that investors can potentially use to their advantage. In this video, we'll discuss how rectangles form, how to identify potential buy and sell signals, set target prices, and what you could do when a breakout occurs. Rectangles form when bearish and bullish investors are trading a stock evenly. This means that when the price nears support, buyers come in and push the price higher. And when the price nears resistance, sellers take over and force the price lower again. Just like a game of tug-of-war, eventually one side proves stronger, and the price either breaks out of resistance or falls through support. Rectangle patterns are similar to flag and triangle patterns, but there are some important differences. Generally speaking, rectangle patterns take longer to form than flag patterns. While flag and triangle patterns develop over a few weeks or possibly months, rectangles usually form after at least 3 months. Rectangles also differ from triangle and flag patterns because rectangles have less predictable volume patterns. Now that you know what a rectangle pattern is and its time frame, let's move on to the 2 examples of strategies that may be considered when identifying a rectangle: trading within the rectangle and trading at breakout. Let's first look at trading within the rectangle pattern. Investors trading this strategy might use support and resistance levels within a rectangle for short-term buy and sell signals. Before purchasing a stock, an investor should first determine at which price he'll place a stop order, also known as a stop loss, to help manage risk. A stop loss order triggers a sell order and is meant to help prevent further losses. These are set at predetermined prices, but there's no guarantee that you'll get the exact price you desire. For example, an investor trading within the rectangle might enter the stock at support and place a stop order, let's say at 3% below support. This means if the stock breaks the pattern and continues moving down instead of up, the stop order will exit the trade, reducing the investor's loss. This strategy can also be used for short positions, setting the buy stop order just above resistance in case the stock has a breakout. Now, on to the second strategy, trading the breakout. Many investors prefer to wait for the stock to break out of the rectangle before entering a position. Why? Because they want the trend to have a clear upward direction before entering. These investors feel most comfortable entering stocks that have momentum and are trending upward. Of course, there's no guarantee that the trend will continue after a breakout, and it could reverse at any time. For those who prefer to wait for the stock to break through resistance as a buy signal, it's important to look for confirmation of the breakout, such as high trading volume. After entering a stock, it's a good idea to set price targets. This objectivity helps investors hold a stock during periods of minor counter-trend movement, when it might be tempting to sell prematurely. In the case of rectangle patterns, setting a price target can be quite simple. Many technical analysts agree that the price target should equal the height of the rectangle. For example, if the difference between support and resistance in the rectangle is $10, the price target should be $10 above resistance. While not a guarantee of success, setting target prices may be a useful strategy for investors who use rectangle patterns as part of their technical analysis. Whether trading in the short term or the long term, recognizing and understanding rectangle patterns can help you make more informed investing decisions.